Good afternoon, everybody. My name's Anthony Murphy. I'm the CEO of Lucerne Investment Partners, and today I'm joined by Andrew Smith, Head of Small Companies and Microcaps at Perennial. Alongside Andrew, is joined by Ryan Sohn, Deputy Portfolio Manager, and Brendan Lyons, Head of Private Investments at Perennial. Guys, thanks for joining us today. On mute. There we go.
Thanks for having us.
Thanks, Anthony.
No, thank you. For those of you attending today, many of you would know that the Perennial Private Public Opportunities Fund No.2 is a significant investment in the Lucerne Alternative Investments Fund. It's also widely held amongst our private investor base, and we thought now with the fund well underway, and the guys were just telling me that they're now fully invested, so I won't steal their thunder and let them talk about that today. But we thought it was an opportune time to catch up with our investors and hear from the team, in particular, how the fund's performing, what the guys are seeing in the market, and they put together a presentation today to support the webinar. So, guys, I might hand it over to you to start the presentation. Just a few housekeeping rules for attendees that have any questions. Please use the questionnaire function at the bottom of your screen where you can submit Q&A, and the guys will endeavour to answer those questions as we go. But thanks again, guys, for joining us today, and I'll now hand it over to you.
Excellent. Thanks, Anthony, and thanks everyone for your interest. I'll start off the presentation just to introduce the rest of the team. So the private to public funds, we have 3 portfolio managers, and you're lucky to have all 3 of us in the room today. We find that works really well. We all get involved once we get to the pointy end of making a decision on investments. So we have to have unanimous agreement across all 3 of us before we put a private investment into the portfolio. So obviously that's quite a good level of cross-check and due diligence. All got different backgrounds. So obviously my background is more on the listed small and micro cap end of the market. So that's the sort of lens I bring. So, at the end of the day, we're looking for the next great IPO. And, my real day job is assessing IPOs and placements all the time. So that's obviously the lens that I bring when I'm looking at these investments. I've been with Perennial coming up to 14 years and in small caps the whole time there. Ryan joined, it's probably coming up to 4 years ago now, and worked very closely with me on the microcap fund and really focused on growth opportunities that we were seeing there. Then Ryan and I started investing in pre-IPO opportunities as a way of sourcing good deal flow for the microcap fund. And as we delved into that more, we really realised this was an untapped area of the Australian market that had very little institutional coverage. So we thought, really great space to develop a capability and create a product. So the first product was the Private to Public Fund No.1. And then I guess through that experience, we realised just how big this opportunity was and is likely to get bigger. And so to help manage workflow and provide a dedicated resource, Brendan joined us last year as solely focused on the private investments. So I think it's working really well. We're very nicely resourced. You may see us add further to this team over time in the private space because we just do see a huge amount of opportunity here. And perhaps I'll just pass around the room. So you've heard my background, which is mainly stockbroking and funds management, and then I'll just let Ryan and Brendan introduce themselves.
Yeah, thanks, Andrew, and thanks for hosting, Anthony. My background started in investment banking, predominantly in the debt structuring, leverage finance space, and from there I moved to an absolute return hedge fund. In that, we did quite a bit of work on the private market and pre-IPO, so really saw the early stage of that market starting to boom. But even there, it was very much dominated by high net worth individuals. Quite a lot of focus on structuring the deal, so putting in place terms for convertible notes or different preference or ordinary structures for straight equity. And then for the last 4 years, I've been cutting my teeth with Perennial, which is certainly an exciting place.
Yeah, I'm Brendan Lyons. Thanks everyone for joining the call. I've been in the equity market or finance market for more than 25 years. The majority of that was with Goldman Sachs or JB Were as it started off originally in Melbourne when I joined. I worked right through to the Goldman Sachs acquisition of that business. I was a partner there for 10 years. Worked in equity research for a large part of that, covering a number of different sectors, and then moved into institutional equities. And my last role there was head of equities based here in Sydney, but also worked in Melbourne, New York and London during my career there. And when I left Goldman, I really started to focus on pre-IPO advisory and investment for a number of private companies. And a bit similar to what Andrew mentioned, I thought there was ability to bring more an institutional grade thinking into these private late stage businesses. We're looking to list on the ASX and get some better outcomes through that process. So I worked on a number of IPOs during that period. I had a small private company pre-IPO investment fund, which has now gone to run off, which I started probably almost 4 years ago now, 3.5 years ago now, so to further test that thesis. Triple P1 fund was started shortly after that. We found there was a lot of overlap between what I was doing and what Perennial was doing as the business grew, and we're looking to launch Triple P2 last year. I came across the group to work full time on this private space and bring some of that, I think, help and expertise. We provide capital. We're also trying to provide guidance and help to our investee companies to get them through to a better IPO and continue to hold them as a public company. So that's my background.
And the other team members you see on the slide there, they're a member of the small and micro cap team. So if we come across investments where they're specialty suits, they'll help us with the due diligence there. And obviously Sam Berridge is well known to Lucerne for his resources. While resources is not a focus for our fund, we don't do cyclicals in the private to public space. Occasionally we do have West Australian based companies and Sam's obviously on the ground there, so that's quite helpful. If I jump ahead, just to remind you the areas of the market we're investing in, we split the fund across 3 distinct buckets. The listed bucket there is only IPOs and placements. And why we have that discipline, so no on-market buying, because we want our entry point to always be at a discount. IPOs, by their nature to be successful, typically have to be a discount to the other available opportunities in the market. Doesn't always happen, but we don't tend to play if it's not a discount to the other observable opportunities in the market. And placements, we're obviously attracted to placements that have a reasonable discount. 10% is a typical discount we're looking for when we're coming into listed placements. We see a huge amount of these, given our $1.5 billion in small and micro caps that we manage. And so this fund can also take advantage, but with a much more a short holding period. We're just really trying to get a good IRR for the fund in its early life through this listed bucket. And I'll run you through that when we go through the performance slides in a little bit. The next area is the pre-IPO area of the market. And this is typically, these are businesses that look almost ready to IPO. They're already of a scale that's sufficient for an IPO. They just maybe need to do some cleaning up, and it's maybe 6 to 12 months away from a logical IPO. And in that sense, a convertible note often makes a lot of sense. What we like about convertible notes is it's a set discount to the ultimate IPO price. So typically a 20% discount to what the IPO price has done. So in that way, we can move with the market. If the markets are soft and the IPO still goes ahead, that's going to be quite an attractive entry point, and we get a 20% discount to that. And equally, when markets run hot, to avoid participating in overpriced IPOs, we put a market cap in the note. So our discount is a lesser of the 20% discount or a dollar figure. And there's been times where that's really kicked in for us, and we've ended up making an 80% uplift just from the convertible note. So Ryan's skills, particularly from his background and his experience investing in this space, has helped us structure these notes to the benefit of the risk return for our investors. And there's a few other funds in the market, maybe 3 or 4 funds that focus on that pre-IPO end of the market. Where we are a bit different is the unlisted expansion and growth area. These typically take a lot more patience, and we'll talk about some of these investments towards the end of the presentation, because this is where we do actually think we make the most money over time, but it does take patience. So this is a business that is perhaps not quite at the scale yet for IPO, and perhaps needs to add some members to the board, some other restructuring to get it IPO ready. So it could be 1 to 2 years, maybe even 3 years away from an IPO or another liquidity event. This area of the market is far less competitive, and this is actually where we can make the biggest impact. And that's advice around the capital structure, maybe adding some directors to the board, and just some general advice of that nature. We often take board observation rights to monitor the development of these businesses. And as I said, this is where we will probably make the biggest returns, but you do have to be the most patient. And so with that, I'll hand over to Brendan to talk about, drill down a little bit more into the areas we invest. And obviously, if there's any questions as we go through, just jump in. I think, Anthony, you're moderating the questions, so we'll just look out for you.
Yeah, thanks, guys.
Yeah, thanks, Andrew. So this slide sort of shows in a simple terms where we invest. It also shows, I guess, where we don't invest as well. We're not doing early stage, seed, startup, venture capital type investments. We are looking for companies which are, as you mentioned, somewhere between 6 months and 2 years from an IPO or other transaction. We've had last 12 months around 11 companies IPO from our portfolio and had 3 takeovers. So some businesses, while they might be on an IPO track, end up going a different pathway. We've always got one eye to the listed market. Is the area where we think we can add the most expertise and where there's often the most valuation uplift from private to public. So we call it, sometimes called LPO, which is the sort of dotted box on this slide. Last private offer is the sort of term we use, and we use it with our companies as well as with our investors. Because the way I talk to the companies is, okay, if you are on an IPO track and we think that the market's big enough, you're the right sort of business, right management team, you're realistic about time frames, objectives, valuation, all the other things that are important for an IPO, then okay, let's work out what the business needs to get there. If it needs further investment, it might be more people, it might be technology spend, it might be an acquisition, it might be a product or geographic type expansion. What do you need to get there? Let's raise that money and then run hard for that outcome. And whether it's a convertible note type investment or it's a direct equity type investment, that's the way we think about it. So we use the term last private offer. Some of our businesses, we know these businesses change. Sometimes bigger opportunities come up. Sometimes they need more funding, and we do some follow-ons. But that's the way we try and think about it. And the shortest one I guess we've done is 3 months. One that was in triple P2, which we can talk about later. Booktopia went from being a private investment of ours to an IPO in December within 3 or 4 months. Although we had been speaking to them for a number of months beforehand, while triple P2 was closing, and they delayed the settlement so we could invest. But often it takes a business at least 6 months to get an IPO, and that's if it's ready to go and got audited accounts and advisors and legal structures and other things in place. But many other businesses, it can take 1 to 2 years. So that's the time frame in which we're investing. As Andrew mentioned, we're not buying companies on market. Effectively, I think about it as we're sort of doing off-market transactions. They're either private transactions or an IPO itself, or it's a placement for a listed business that we know very well, which once again is a discounted raise, effectively off market. Just on the next slide.
Brendan, just on that, how reliant on the IPO market are you, and how you're seeing it at the moment? It's obviously pretty important to the fund.
Yeah, so the IPO market has been strong in the December quarter in particular. If my memory serves me correctly, we saw 54 IPOs on the ASX in that quarter. I'm sure that was a record number. Typically, we do around 100 in Australia per annum, plus or minus 20, because that's sort of the range I guess we've seen in recent years in terms of number of IPOs. A lot of those are resources companies, mining companies. We don't do any cyclicals or mining resource oil and gas companies in this portfolio. We have Perennial has a fund manager and a fund based out of Perth who focuses on resources. But because we're a 5-year fund, we don't want to be beholden to macro cycles, whether it's the iron ore price, the gold price, or any other commodity for that matter, which includes agricultural commodities and industrial commodities. So we don't invest in any of those sort of businesses. So of those 54 IPOs in December, we participated in 8 of them. So we are still very, very selective in what we invest in. And I think our view when looking at the IPO market is not dissimilar from looking at other things. I mean, our ideal investment is that company who needs a private investment, as I mentioned, 6 to 2 years out from an IPO. And then we're looking to put more money into the IPO at that stage. That's one of the key differentiators, I think, for our business now, our mandate compared to, say, venture capital or private equity, or even strategic and family office type investors who are often trying to exit at the IPO. We're looking to invest more at the IPO. Our fund is like that. But in terms of the market itself, I mean, I think the IPO remains strong again this year. We've got the March quarter, as we talked about in our newsletter, is seasonally a quieter quarter for ASX issuance of all types. January is obviously a holiday month. February's reporting season. And what you find is most companies who are trying to IPO are really trying to hit 2 major windows. The major windows are the second quarter and typically sort of late third quarter into the fourth quarter, once again missing August reporting season. So they're the 2 perfect IPO windows in Australia. You see the businesses.
I may just add in a couple of points there. And the way, if you think about most of the pre-IPOs, they're convertible notes. They've got a set maturity there. So if the market's really hot, we've got that cap in there, so we get that discount. We got the cap which kicks in. But if the market's weak and there's less IPOs coming through, there is a maturity date which does sort of trigger potential IPO. And if the market's really soft, then the ultimate IPO price gets pushed down. So we convert at that discount. We saw December sort of 2017 that during that tech sort of window when it was all sort of melting down. That's in the micro cap fund. We had a pre-IPO position in Atomos. That was a great example when no businesses were getting away. We were able to make sure the IPO happened at a more attractive price and the business performed really strongly and we converted at that. And then the expansion and growth businesses, we think those businesses should grow irrespective of what market conditions they are. So if they need to delay an IPO by 6 months, they should just continue to go through that.
And in a nutshell, it's about having more flexibility in your mandate, right? Which is one of the the strong suits of the strategy, but also you have the ability. I remember it was a Uni Wireless story where you did a down round even into the IPO. I remember.
That's right.
Yeah.
So we do see windows like 6 month windows. From the GFC onwards, there were definitely GFC. I remember was a 6 month window where the IPO market was shut. We actually don't mind that because it helps us when we're negotiating terms. So we like a little bit of softness. Just recently, the current batch of IPOs, which we've largely sat out of, have been pretty poor as an average. I think something like 8 out of 10 are underwater just this batch this calendar year. That actually helps get the pricing better for the next batch, which we're already using to our advantage. So we like a little bit of choppiness in the IPO market, and we haven't seen the IPO market shut for more than 6 months. We obviously had that in the GFC, we had that in COVID, and pleasingly in both and then December 2017, which was the taper tantrum, we actually had one of the few IPOs coming to market in that period, and they've actually been great returns. To your point, Anthony, too, that Unity Wireless example, which is also from microcaps, we want to ensure that every dollar we deploy is in good value. We don't mind paying more if the risks are lower. So as a company progresses to IPO, the risks are reducing. But we want a really nicely priced IPO. So we get involved very early to help set the value, the pricing, because we only want to be involved with successful IPOs. So Unity, we did actually push the price down of the IPO. Ended up being a 25-cent IPO, and the stocks, you can see it's a top 200 stock now. It's been very good for our microcap fund. So yeah, good examples there. And the 5-year fund, it does allow us some flexibility to time our exit for these investments.
I don't think a lot of people would be aware that I guess the point I'm trying to stress here, that a market dislocation or a pullback in the market could actually long-term benefit the strategy, not the other way, whereas most people probably think it hurts the strategy. It might in the short term, but ultimately could actually lead to greater value being realised.
Absolutely.
We're very focused on valuation, Anthony. So when you have frothy markets and things, and that's what we saw a bit in that December quarter, that's why we didn't participate in a number of those IPOs, is that it can go on for a bit longer than you think. But we're very valuation focused here. We use long-term rules of thumb for valuations of all the different sort of segments we invest in. And so, to try not to get caught up with that. We do it in the private market. We also do it in the public market. And we're in the fortunate position that we see so much deal flow that we're happy to move on to the next one. And interestingly, we often find in the case of some of those IPOs, Nuix would be an example recently where we didn't participate last year, performed very well initially, and then it's obviously had a couple of profit warnings since then and come back materially below its issue price. And there's been others, like Adore was another one we didn't participate in where we thought it was too highly priced, and it's traded down since then. So we think that those things, as long as we get them right, can be helpful for the next deal that comes along, because it just provides more of a marker. But the very, very large IPOs you see in Australia, of which there's always seems to be 5 or 10 on the horizon, not that they don't always get done. Like, you won't always find us, when we look at them all, you won't find us participating in a lot of those, because in many cases it's not an area where we can add any value. In many cases there's large sell downs involved, sometimes at a private equity or something else, which creates sometimes a bit of a conflict where the valuation should be, and sometimes the structure of them just isn't something that appeals to us. So we tend to focusing more. We've got this expertise in smaller microcaps. That tends to be more where our private investments are, where our IPO investments will probably be.
And to your point, Anthony, on choppiness in the markets, it's probably helpful to talk to this slide. It's Triple P1, which is obviously a year and a bit older than Triple P2, so it kind of gives you a sense of what a path could be. And we did have choppy markets in that February-March period. You can see, as we know, I think small caps was down, I think 22% from memory in March. It was pretty brutal. We took all our listed exposure down to pretty much zero in February. But then that repricing that was caused by this enabled us to participate in a lot of deals and really set the fund up nicely for the returns we're seeing now. So if you cast your mind back to that slide I spoke about, where we've got 3 buckets we invest in. The first bucket, which is just placements and IPOs, that's making an impact here in the early life of the fund. So just small positives. Obviously, we have some negatives, but the aim is small positives. If we're going into a deal, we're looking to make 10, 15% and hold for 2 to 3 months. And so that's the impact of those investments happening there. The actual returns from microcaps and Fund 1 are actually better than that. The average return from our placement bucket is 20%, just a bit over 20%. So it's nice to see that repeated, because that was the microcap average as well. But then the real kick to performance is when we have a business transition pre-IPO to IPO. So we had the first IPO coming out of COVID. It helped that it was actually a COVID beneficiary. That was Atomo Diagnostics. And then we had 4D Medical. Ryan, what were some other names coming through here?
Aussie Broadband.
Aussie Broadband was in August.
And Maz Group.
Yeah, and Maz Group, which is an infrastructure play. And so these had a nice impact on the fund. So this is the pre-IPO buckets coming. We also had a takeover, which Brendan mentioned. That happened in August. So it's a nice little kick. This is where we're going to make the decent returns on the fund.
Yeah.
And then we just kept participating in listed bucket. Again, we cashed up around this February period. And then we had our first really meaningful impact in this month. So we've marked this up. We've got an expansion asset, which is Animoca. Our entry price was 18 cents. There was an opportunity to buy some more stock at 25 cents, which we did. It's all Aussie dollars. There's now been a very large transaction from a US and UK investor group. They're paying $1.10. And so that markup has impacted our April results. So important reminder that everything we do is carried at cost. So that's the first time Animoca has actually delivered anything for us. And there's about 70% of the portfolio that's still carried at cost in this number. So we're really proud of the performance today, reflecting that. The good news, as you see on the
you just want to stress a little bit more, Andrew, there what you mean carried at cost, because I think it's quite important.
Yeah, so Animoca is an example. We actually delisted that from the ASX. So we do go the other way when we think that the market's undervaluing the asset. And that was 18 cents was the last traded price. So until there's an event, a tangible transaction by a third party, we don't reprice our assets. So even though Animoca, which is a blockchain gaming business, even though we saw their revenues were growing fourfold on when it delisted, we didn't change our valuation because we need a third party to validate pricing. And that can be up and down. You know, the Unity Wireless example was actually down from microcaps. We've got one in here, NutriCare, which we've actually written down twice. That's in these numbers, and that's on basis on a tangible capital raise. So Animoca had a nice impact. As I said, blockchain gaming, so right in the hot spot at the moment. And we're considering whether we take a little bit off the table as well, just because it's becoming so big. The great news for investors in PPP2, even though it's very early in the life of the fund, we were able to buy some secondary stock in Animoca, so that's also had a nice impact to this fund in the month of April. Again, similar to the starting life of PPP1, the listed buckets had the most impact. We started cashing up here for new deals, and Booktopia made that nice jump in returns there. So that was a very quick pre-IPO deal. While 70% of Fund 1 will be carried at cost, it's 90% of Fund 2 is really carried at cost. So really excited about what could be ahead for PPP2 as these investments mature. And Brendan and Ryan will run you through some investment opportunities for that. But just to put those two charts into context, I'll let Ryan talk to this, which compares the life of Fund 1 at the exact same vintage and same age as Fund 2.
Yeah, I think what's really...
You're setting yourselves up here, guys.
I know.
It's a good point. But what's really pleasing about this chart is we can see the correlation between 1 and 2 at the same stage of life. So since inception to the first 7 months, they've now crossed over. So we think that strategy of chipping away in the listed market, getting that IRR ticking over is quite a repeatable strategy whilst we go through that deployment stage. So Fund 1 now is really starting to getting all three buckets participate into performance, whereas Fund 2 is we're chipping away through that deployment stage, but the return profile is starting to take shape. So we should start to see that layering like Fund 1 in the next sort of 3, 6, 12 months. But it's nice to see the strategy play out as we expected.
And you raise a great point. This is probably only valid in the early life of the funds. As we get further out, obviously the timing of the big deals like Anamoke is going to be completely different. So
Sure.
that in a year's time, this chart might not be as helpful. But I guess Fund 1 shows you what is possible. As you hear us when we talk about Fund 2, we actually feel we've got actually better investments in Fund 2, much bigger scale, lower risk investments. And so we're really excited. We'll spend a fair bit of time talking about them in a sec.
Sure.
Yeah, and this is a nice slide which shows where our deployment and the current allocation. So Andrew ran through the three different buckets and how we look to deploy that. You can see as we sit at the 19th of April, where roughly 30% invested in pre-IPOs, and then we've got 17% cash still looking to be deployed. As we sit today, we've finalised 4 further deals, 2 pre-IPOs and 2 expansion and growth, which makes the buckets look exactly what they should do, which is almost fully invested, with the opportunity to start looking at recycling positions as some of those pre-IPOs come to market. So we do expect sort of potentially 3 or 4 of those to come on, transition from pre-IPO to IPO within the next 3-6 months, which then opens up some more capacity there. So the buckets are taking shape, and to Brendan's point, the opportunity set is really big, probably bigger than we expected. So the deployment of capital into these buckets being faster than probably anticipated, and that's due to 2 things. One, the number of opportunities that we're seeing, but also private companies are now looking to raise more cash than they did before. So looking to stay private for longer. So the check sizes are increasing. No longer is a pre-IPO looking for $1 to $2 million to sort of get themselves ready for a listing. They are looking, sometimes 15, 20, some are looking for $100 million. And they're looking to get their register set, get the right investors on board so they can have a successful listing. So the deployment's been probably faster than anticipated, but in a really positive manner.
Yeah, I think that's right. The window's certainly increased in terms of both number of companies and the size of the investments. Companies that would have gone straight to IPO are now doing a pre-IPO round to just stay private a bit longer, get themselves a bit better organised and give them a better run at the boards. And just on this, I guess it's probably worth highlighting that there's quite a bit of diversity in what we're investing in as well. And we'll run through some examples in a second. But in terms of where the portfolio sits, there's in that in the pink one, which is growth and expansion, there's around 10 investments in there, and in the, I guess you call it the light purple, the pre-IPO convertible note bucket, there's around 18 in there at the moment. So it is quite diverse. And we often get asked what sectors are you investing in. I mentioned earlier we don't do any cyclicals, but it's a mixture of healthcare, software, e-commerce, professional services, and some high tech or device manufacturing as well as sort of the major groups, and then some other, I guess, broader technology plays, which, like the odd marketplace or something like that, which is more like a tech platform. And so it's quite broad. It's really, we're agnostic other than looking at, we're looking for great business we think can clearly IPO and be successful outside of the cyclical parts of the economy.
And so in a nutshell, the reason why you've deployed so quickly, just to remind the audience, it's a 5-year fund, and we'll talk about what that actually means shortly. It's a 5-year fund. Sounds like all that capital's been deployed within the first 6 months, and that's purely just because of the amount of attractive deal flow that you've seen. Exactly right. And to put some numbers around that, when Ryan and I kicked off this strategy with Fund 1, we were seeing 200 potential opportunities a year. That's now over 800 on the current run rate, and we're taking about 5% of those deals. So we're getting pickier. The quality is getting bigger. Of the 800 you've seen, because 800 is just too many, right? You can't give them all the time that they require. Of the 800, how many do you cull very quickly? Yeah, so that's actually already a cold number. So that's screening out
ones that don't fit our sector or our revenue threshold, which is 5 million minimum revenue. So we do take a meeting. We're very open-minded because you never know, things can really jump out at you in a meeting. But look, of the 800, there's probably only 10% which go to the next stage, and then half of them that go all the way through. So yeah, we do filter it down quite a bit. So I think, and the other implication from this is it's great getting invested early, so we maximise our flexibility in exiting these investments, and obviously the ability to recycle, particularly the recycle the pre-IPOs. We can go 2 or 3 times in the life of the fund. Growth and expansion, if we had a takeover, for example, we could recycle some of that if it's quite early in the life of the fund. So we will be doing a Fund 3, given the universe has expanded way quicker than we even thought in October last year. So we will be in the market in July doing a third fund.
Thanks.
Yes, so it could be a good chance to take some questions, or I'm happy to talk to what I think is probably the most exciting slide, because this is what we're invested in and what you guys have got exposure to. Some really exciting businesses in here, but I'll pause for a couple of seconds if there's any questions there.
Yeah, no, a couple of questions to come through. You've actually, by coincidence, sort of answered along the ways, guys. So that's actually worked out well. But yeah, I think regarding this slide, given the majority of the audience today is in Triple P2, probably focus on that more so, and maybe talk about just a couple of examples here. Dovetails from what you said before, Brendan, about some of the industries that you're invested in, those that you stick clear of.
Okay, I think we can see a couple of the questions that have come through there as well. I think you're seeing the same ones about why does Perennial make a good partner for the business. And I think we just to answer that one, we've touched on it briefly before, and then we'll get into some of these examples. But effectively, I mean, people, as I said, we're trying to find the founder-led business where they've still got a very meaningful stake in the business. We're not trying to run the business like private equity, and we're not doing early stage like VC. We're just trying to help them with both capital and guidance to get to a successful IPO. And so what we find is those founders and business owners that do it the same way as we do obviously make excellent partners. We are investing in the people as much as the business in that situation. So if someone's looking to do a large sell down, looking to exit, maybe retire or take a lot of money off the table, that to us is a different pathway. That to me is more private equity or trade sale. And we sort of, we obviously, they're not they're the sort of businesses and investment opportunities we're not going to get out of first gear with. But those who are looking to run a public company one day, and some knowing that sometimes they do get taken over because they get a sky high bid, which we've had out of both offshore into an Australian company, and a couple of the others were bid for by large Australian institutions, then really we're looking for those who want to run a public company. And what we say to them is that we'll invest now, we'll help you get there. We can help you with the counterparties, the investment case, and board and other sort of strategic and some of the other elements you need for successful IPO. But we'll also look to invest more at the IPO and hold you as a public company. The other perennial funds can then invest. And that's quite powerful, I think, for a lot of these founders who are thinking the same way as we are. They're looking to hold a shareholding and keep growing their business. So that's sort of what we focus on. And I think it just resonates well, and it's sort of becomes self-selecting at some point. The businesses and the owners who think the same way as we do end up becoming, we can become a good partner for.
And I think there's another question about investment pipeline. That's probably quite, in terms of where it's sourced. We could probably give some examples as we go through Fund 2 where these deals have come from. So I'll let the guys speak to that. And the short answer is the deal flow comes from everywhere: brokers, advisors, increasingly directors and founders networks. So we've had a good experience investing alongside Perennial, and then they've referred their friends and colleagues. And we're getting companies come to us directly as well, which is helpful. And in many of these transactions, we may be the only institution that's in there. Sometimes we're the only money entity they're taking money from. If they're
that's a key point. So what percentage of transactions you do would you say that you are the only one in the tent?
We haven't really run the statistics because we are agnostic. If there's a great deal that someone else has led and introduced to us, we'll come along. I'd say it's been increasing though, and we can certainly do the maths for you on this page. So on the right hand side, just looking at those, I would say two out of the Triple P2 logos that are up there are just us. I know Locator, for example, we're the only investor, and we led the round, we priced the round. No advisor was involved. And to give you some context there, the valuation we pitched it at was half what a US firm was prepared to pay. But this is an Australian-based business that you need to do due diligence on, and the US firm couldn't come out here because of COVID, so we could move pretty quickly. We've known the company for over 5 years, so it was a trusted relationship, and we got half the value, and we think that's going to be fantastic.
Okay.
Yeah, to echo, I think more and more we're probably leading or being the only person, but like Andrew, we are agnostic. If it's a good deal, it's a good deal. If we're the only one, or if there's other people in there, we'll sort of take it.
So perhaps, Ryan, you want to talk to some of the logos here and what these businesses do?
Yeah, so I'll focus on the PPP2 investments. Interestingly, there is some crossover with some of the businesses, so I can touch on those in due course. But starting with top left in PPP2, there's Locator. So that's a business that we've known for many years from one of Andrew's contacts. They are sort of precise location technology business. So they use the analogy of GPS 2.0, or think about it as Swiss cheese. So GPS works really well, but there are some holes in certain environments. So if you think about sort of closed environments or high density environments, or even really simply when you're driving in a tunnel and your GPS sort of goes out of whack, that's when GPS doesn't work. Locator works in these environments with this high density open cut mining. So the use cases are really broad there. Think anything autonomous that's looking for high precision location technology has got a use case for Locator. So we wrote about it in the last quarterly that hopefully you can all read a bit more in depth. But the company's really, they've been around for 15, 20 odd years, 170 odd patents, and they've got immense expertise in this field. The R&D has been amazing, but we're really entering at this point of inflection whilst they commercialize and win some really large deals. So they've got contracts with the US Defense Force, NASA, Caterpillar, and these are all varied use cases, but all got to do with that precision technology in different cases whereby GPS doesn't necessarily work.
And one of the most logical would be they're deployed in the Port of Auckland, also Port of LA, and a couple of contracts in Europe as well. And that's where they're trying to automate the port. But because containers are obviously big metal boxes, the GPS signal bounces around. So they use Locator as a replacement to drive those autonomous cranes that are working on ports. So they needed the capital for exactly the right reasons. They've got so much growth ahead of them. They need boots on ground to implement these Locator networks. They had one big amount of contracts. Caterpillar is the most significant recently. So exactly the type of investment we look for, where our growth capital is getting immediately spent on bringing revenues in the door. So really excited about that one. One of our biggest investments in Fund 2. Carried at cost, though, as you'd expect.
Yeah, great. And look, one of the questions come to us, do you invest in companies globally? So, I mean, I take that question as, does any business that you invest in have to have a pathway to listing on the ASX, or can you go outside that with your mandate?
Yeah, it's a great question. So we say we'll invest in OECD, OECD countries but we have to have a tangible sort of connection to the business, whether that's management or board. And we do want that business to be able to list preferably on the ASX.
Yeah, sure.
And a great example is Spire. You can see that in the pre-IPO bucket. That's a nano satellite technology that is based out of the US, but they were looking to potentially list on the ASX. So we got involved with the business. It's actually an investment in both funds. Now, the business was on the ASX path. However, they got they've sort of deviated somewhat and had a sizable investment from two US funds, Tiger and BlackRock, in advance of a potential SPAC merger. So that business is still carried at cost, but it's quite a material uplift to what we hold it at, but we'll wait until the vote goes through. So yeah, short answer is we do invest globally, but we need to have some tangible connection to the business.
And that's due to list in the US summer, so July, August, on the New York Stock Exchange, just waiting for the vote to come through there.
Yeah.
Right.
So maybe I'll touch on a couple of other businesses. I'll jump around a bit. I'll go to PPP2, so the pre-IPO. Lumos Diagnostics, that's quite topical because we think that's going to be the first or not the first, but the next pre-IPO investment from BBB2 that'll transition from pre-IPO to IPO. So that's a point of care diagnostics business with quite large services and manufacturing contracts. The business has grown really rapidly. So we invested, but whilst it was private, we had quite intimate knowledge of the business through our investment in Planet Innovation, which is an investment in BBB1. It's actually a spin out of the business. So we've tracked that business for quite some time, and they consistently beat their forecasts. But we're really excited about their own technology, which is called Febridex, which can differentiate between bacterial versus viral infection. And they'll start with respiratory conditions. So, but if you think about the overuse of antibiotics, the use case of this, it could be immense. It's a really big opportunity. But that's still awaiting some approval, but the upside to that is quite large. So that's a convertible note that we've got. It's going to transition to an IPO in the next month or two. And again, a different sort of space, medical technology, but an exciting business that we've known for quite some time.
And the benefit of seeing that business through our time owning it as a private business, it's also part of Planet Innovation, which is the PI, which is again held in both funds. So we've watched this business progress. It's beaten expectations materially each quarter. So with that in mind, we're obviously pretty keen to write a check at IPO because we know this management team can deliver. Yeah. And just given you mentioned some global opportunities, one that might also go that way, I'll let Brendan talk to, but Exchange, that could get pulled to the US just given the size of the opportunity.
Yeah, Exchange is a business.
I was going to say, Andrew, I think the actual day that you and I first met was the afternoon you put a bid into Planet Innovation. So there you go.
Oh, right. Yeah.
Good one.
Very excited about that one when we can bring that to market.
Yeah, good. Sorry, Brendan, go on.
No, I was going to say, I mean, you're getting an impression about where the different deals are coming from. They're coming from other businesses we know, or coming in directly, or relationships. Exchange came from a broker that someone I actually used to work with at Goldman for a long time ago. It's a merger of an Australian and US. It's a global business, Australian and US sort of ESG commodity platform. So they trade, effectively the only ones in the world that do it. They've put together a number of assets across trading of everything from carbon to water to their own products, which they're developed for the airline, most recently for the airline industry, carbon offsets. They do a registry business as well as a trading and custodian business. So they put those together. It was a pre-IPO convertible note that we started talking to. I first met the business, or started hearing about the business in August last year, shortly after I joined Perennial.
Second day on the job.
I think it was certainly in that first week. We ended up not finishing the transaction till the end of the year or early part of this year. Now, it's been in the press a little bit, and we've talked about it in a couple of newsletters, and there's been a couple of AFR articles about Exchange because it is on an IPO track for Australia. But if you look at, there's 3 or 4 major exchange groups globally which dominate that space, and none of them are in the ones that own. I'm not talking about the ASX. I'm talking about the US and European exchanges. It'd be interesting to see which way this business goes. At some point, it could be attractive in a trade sale path. It could be an IPO on the ASX, or it could be an IPO in the US because it's growing quickly. They're the only ones that do what they've done, and they've been able to. And it's taken them more than 10 years to put the businesses and the assets together to create a pretty unique platform to trade these ESG commodities, which is clearly a very fast-growing market with more and more companies looking for ways to do that. They've got some interesting shareholders as well. Macquarie have been heavily involved from helping to fund the business. BP Ventures is another key shareholder in it. So they've got some large corporates, and those two together are the largest gas traders in Australia, and
the US.
And then the US,
yeah.
And they're using large global gas traders, and they're the ones using the platform to it's a type of product called certificated gas, where you're trading gas from an ESG rated gas well. So it's quite interesting. It's new products. It's a meaningful business already. But we just think that's quite a unique exposure, which is hard to find elsewhere.
Some other questions have come through. How long do we hold an investment once it's listed? We're very value driven, as you can probably tell from what we've spoken about. So obviously, if a company does fantastically well and gets well ahead of our assessment of value, we'll look to sell. Sometimes we've got escrow requirements. So obviously, we honour those. But because we're going in with the view that we're going to hold this business for at least 1 to 2 years post IPO, that doesn't bother us having some escrow. And then obviously if a business changes strategy or starts to deviate off a path which we think is sensible, that's a catalyst for us to sell. So valuation, any change in strategy would be the triggers for selling. And then we do think about catalysts. So we're thinking about, okay, we've got say $5 million in 4DX Medical, for example, and we're seeing this great pre-IPO opportunity, which we think we can make 3 times our money. There's no more catalyst left for 4D Medical. I actually think there is, but I'm just using it as an example. Then we might recycle that capital and put it to work in the new one. So it's a blend of those 3 decisions. So we still have in Fund 1 some assets we've held all the way through to IPO. Booktopia, for example, we still hold. We haven't sold a share. They've upgraded once. We suspect there's some more to come.
Just on that, just in the interest of time, because we're sort of hard stop at one, I think around managing those positions, Andrew, do you just want to talk to the concept? The fund is obviously, and this is triple P2, but the fund is 5 years. So how are you going to sort of manage, I guess, the life of the fund to get to time T, and how does that work for just so investors are fully informed?
Yeah, so hopefully this fund timeline might be helpful.
Perfect.
So when we set this up, the reason we had the 3 buckets is the different liquidity and time profiles. So IPO and placements were very active throughout the whole life of the fund. As you can hopefully get from this graphic here, we might rotate 3 or 4 times a year in this bucket. Pre-IPOs, as I said, we can maybe get 2 or 3 turns out of a pre-IPO, typically 12 to 18 months holding period, but we're not going to make any more investments from year 4. And in reality, we're probably coming up to maybe 1 more year of investing in Fund 1 in this sort of year 3. We don't really want to go much beyond that because you just want to allow some time to exit and not have a gun to our head to sell these positions as we get to the end of the life of the fund. Unlisted expansion and growth, we want to get invested as early as possible, and given what we've disclosed to you, that's happened in both circumstances, triple P2 even earlier. So we've now got this whole time period here to look to maximise our return. And part of that could be patient. Some other investors that they want to get it to IPO quickly because they need liquidity. And we've said, like, Koala is a great example, koala.com, which is actually also held in both funds through different instruments. We said stay private because you're growing so fast. We're going to make so much more money if we wait another year. So Japan's now half of their revenue. That's the online mattress business. They're going to South Korea. So let's wait another 6 months, 12 months, and we'll make more money. The other point is this realised return of capital. So the gains that we make. So we put $100 in and we sell that for $120. That $20 will get paid out at the end of each financial year. So Fund 1 paid out about 5% in year 1. It's on track for about a 20% of initial capital coming back in year 2. Triple P2, we were looking at the other day, it's a single digit.
It'll be about a sort of 3 to 5% range, but it's
in year 1.
Probably, as expected, it still wouldn't have expected to realise too many returns at this stage.
Yeah.
And then obviously for the audience benefit, what the guys are saying is that you actually don't have to wait to the end of 5 years to realise your return. Your return is actually coming in on an annualised basis.
Yeah.
And perhaps, Anthony, just the questions in the interest of time that you want us to step through that have come up here. Risk in the portfolio.
The risk in the portfolio, you sort of touched on that in terms of if there's a catalyst or if there's a change, but yeah, feel free to expand on that.
Yeah, the other rule we have is we can't invest more than 10% in any one business at the time of investment. So Anamoka is an example where that's done so well, it's gone well ahead of that. So we can't put another dollar in. We actually naturally look to sell once the business has started performing that well and gets to 20% of the fund. We'd look to take some profit. So we manage risk by spreading our investments. So pleasingly, we've got one asset out of Fund 1 that's causing us some headaches, but it happens to be the smallest because we sort of sized it that way going in. None in Fund 2 at this point. Never say never, but that diversification and that portfolio approach is another way we manage risk.
The other thing is the use of different instruments naturally sort of helps you diversify the risk. So we're not just wedded to just straight equity all the time. So we've got a broader brush whereby we've got convertible notes in there, it tends to be about 40% of the portfolio. So we don't have a straight equity exposure there. We sort of move up and down with the market. So it's sort of portfolio spread, but then also spread of the instruments that we use.
And we think about duration of the investments as well, which goes to that fund timeline. We do map out when we think things are due to come, when convertible notes are due to expire, or when we think something will IPO. So we do try and think about layering those investments so that the duration spread out over a number of years, so you're not trying to IPO all your investments at once. There's a question here, Anthony, about triple P3, and I know
I guess triple P3, as the information comes through for that, we'll circulate that to our investor base, but I'm assuming it's going to follow the similar concept to 1 and 2, guys.
Yeah, exactly the same, and July will be the launch date.
Yeah,
just a bit of devil's advocate here. Let's assume in with triple P2 here, say we're 3.5, 4 years down the track, and market conditions are really unfavourable. We're in very difficult conditions. What sort of tools and flexibility do you have because it might not be in the best interest of the fund to actually, return that last dollar of capital in year 5? What do you have up your sleeve?
We've got a few. We think we get asked this question from time to time, and we do think about it. There are a number of
because you don't want to be a forced seller, right? That's the whole point. You don't have to sell
right.
It's just for the sake that we're coming up to the end of year 5.
Yeah. No, so there's a number of tools which you can use when you get to the end, and we would hope at the end, if you had some investments left, it would be a small number. That would be the intention. You've realised most of them and returned most of the capital by that point. But and these are sort of outlined in the IM. But effectively, you can with the shareholders vote, we can extend the fund if we had a couple of things we were trying to work out at the end. Another one, if we had one left that was close to an IPO, you could in specie it back to the unit holders, so they ended up holding something that was about to list. We've got some evergreen mandates which could be helpful in that stage. We could potentially transfer assets between them, or we just put the fund into runoff and just reduce the fees, I guess, and we're no longer being as actively managed. But our intention really is to return as much capital as we can, if not all of it, within those 5 years, and that's why you need to get invested early in this private space. And if you look at the pre-IPO and the IPO and placements, and they're obviously quite liquid, so we have the ability to exit those positions or turn them over as we go along.
The other pleasing thing for Fund 2 is the fact that we have actually deployed quite early, which is not necessarily by design, but it is actually it's good because it gives these investments a longer time frame to realise their return. So
gives you guys more flexibility. Yeah,
exactly. Yeah.
And we've already started on Fund 1, where we've literally gone through the ones that look furthest away from maturity, and we've actually started to engage some people if they want to buy them off us, because that can take time, right? So we may as well start at the end of year 2, already start the work to really give us the maximum flexibility there.
The other option you also have is because there are more entrants in this space at the moment. We're seeing a number of, I guess, what you would call your competitors in the space coming with different funds that you're obviously reasonably close with those peers. You work on a number of transactions together. So I understand there is a little bit of from time to time
some secondary.
Secondary market buying and selling of assets amongst your peers.
Yeah, and we've actually only ever been a buyer in that circumstance, and obviously given our value bent, we like it when some of those funds are distressed or desperate sellers. So we've actually made some good returns for our investors by being active. March last year, December 17, we were able to buy some nice positions there that were distressed and got them at very attractive places. So I personally wouldn't want to be in this situation where I had to sell to one of my competitors, but you're right, that's an option.
Sure. Guys, we might call it there. It's just in the interest of time and keeping this to an hour. For our audience out there, if you did have any follow-up questions, please email them directly to the team, and we'll ensure that they're answered by the guys. But Andrew, Ryan, Brendan, look, really thanks for your time, guys, and congratulations on the success of 1 and also the unfolding of the success of 2, which looks like it's certainly on the right pathway. So guys, well done. And on behalf of all of our investors, thank you very much for your work.
Thank you very much. Appreciate the support.
Thanks,
Thank
everyone.
you. Bye.
Cheers, guys.